It's time for stock picks. Now, with big tech having released financial results for the closing quarter of 2024, Byron Lotter from Vestact joins me with his analysis of Nvidia, Meta and Microsoft. Byron, thanks so much for your time this afternoon. As I just mentioned, we've just wrapped up the tech earnings season. Before we get into some of your picks in the space, what have you made of valuations? I mean, we know these companies are really pricey at the levels they're at, but are you bullish on entering these companies at the specific time?
Hi, Ling. Thanks for having me. I guess it depends what your definition of pricey is. As with everything in life, you do have to pay up for quality, and these businesses really are quality when you have a look at the underlying fundamentals, the underlying profit growth, the margins, the moats around their businesses. Nvidia looked incredibly expensive last year when it was trading at 150 times earnings. Now it's trading at 30 times earnings because the profits have grown so much into the share price. Likewise with many of the others. So I would say the current valuations look decent. I wouldn't say they're screaming buying cheap opportunities, but I think if you're a buy and hold investor and you're willing to hold stocks for the next 10 to 15 years, these are great businesses to be buying right now.
So let's kick off then with Nvidia. Numbers out last week. As expected, numbers were stellar. The revenue, I think, was up close to 80%. And, they beat expectations on the back of higher demand for chips and on the back of stronger demand, AI demand, that is. So take us through your analysis of that company and why it's one of your stock picks in the space.
Yes, I mean, everyone wants to talk about Nvidia these days after its meteoric rise to the $3 trillion club in a very short space of time. And rightfully so. As I mentioned earlier, this is one that really has the underlying profits have grown into the share price and fully justifies, where it's trading at the moment. Having said that, it has pulled back from about $150 a share, which are the highs, to about $125 at the moment. Although there are outside factors affecting these tech stocks, like the Trump tariffs and general sentiment. But the earnings were incredible. The expectations are very high for the stock, so it's always a huge release when those earnings come out, because it seems to be what everyone seems to think, that this is going to determine the trajectory of the stock market going forward the next 6 months, because so much of the growth has been AI dependent, and Nvidia has been the darling and sort of the barometer of that. But again, the results were fantastic. I mean, so, as you said, revenue's growing 80%, profit margins of 61%, huge net profit of $22 billion. Over 90% of that all coming from data center spend. So you've got the Microsofts, you've got the Metas, you've got the Amazons and the Googles. These guys are building massive data centers to support their AI businesses, and Nvidia chips are absolutely essential as the hardware and brains behind those data centers. And when you look at the projections, and this is coming from the companies themselves, not analysts who are sort of making assumptions. This is coming from these big tech companies. They are saying that they are going to be spending huge amounts again this year. Amazon alone are looking to spend $100 billion on infrastructure and capex this year going forward, and a massive amount of that is going to be in data centers and buying Nvidia chips specifically. So the future is still bright. I don't know if we're going to see the same gains we've seen from Nvidia. So if you're expecting another 10, 20x in a short period of time, that's not really where Nvidia is at the moment. But if you're looking for solid growth over the next 5 to 10 years, I still think Nvidia is a good one to own.
Byron, then is that where the disconnect is at? Because, we can agree that, we can all agree that Nvidia is really releasing good results, stellar results. But I think the day after those results were out, Nvidia was down over 10%. Are markets just expecting too much from Nvidia?
Yeah, like I said, there was quite a few outside factors there.
Okay.
The results came out pre-market, the share dropped a few percent, then it was in the green for a while. And then later on in the day, the entire tech sector took a massive hit,
Aha, okay.
which was seemed to be more general sentiment. You know, these stocks have done very well. So when sentiment changes, they seem to be the first hit. And Nvidia specifically, you probably find there are, you know, people with huge positions in Nvidia, just purely based on how well it's done. And whenever sentiment shifts, that's the first one to get sold. So I think that 8% drop on the day was more to do with the sentiment shift,
Okay.
as opposed to people digesting the numbers and finding something in there that no one else noticed and thinking that it's actually a sell. So I think that answers your question. I
Yeah.
don't think it had anything to do with the numbers.
All right, let's move over to Meta, one that's really been aggressive when it comes to its AI spend. I think it's put aside about $65 billion for 2025. And you know, US tech companies have recently come under fire on the back of their capex with the emergence of a DeepSeek. Have the cost of building these data centers and trying to build up on tech infrastructure worried you?
Not at all. I mean, when you have a look at what's coming out of the numbers from the likes of Meta and so on, they're talking about a return on equity close to 100% per annum for these chips that they're spending. So they're basically getting their money back in 1 year on what they're spending on these chips. They've also mentioned that they'd rather be caught spending too much than too little in this AI game, because the competition is so rife, because the upside is so huge. You really don't want to be caught out underprepared for the big boom. And the good thing about these businesses, and the same applies to Microsoft and Meta, is that they have the money to spend.
Yeah.
They're incredibly profitable businesses. They still have massive balance sheets. It's not like they're betting the house on this infrastructure. They're not taking out massive loans to build these data centers. They're using, you know, money that they're making from their existing businesses. So, you know, Meta is making $46 billion a quarter on advertising, and they're taking, you know, with gross profit of $40 billion, operating profit of 23. They're then taking a portion of that money and investing in the future. And it's, for a business like Meta, a huge amount of that spend is also going towards the algorithms for Instagram and Facebook and WhatsApp, which is feeding the right things to the right people. So they're actually using that infrastructure to increase the services of their existing businesses. Again, it's not just pie in the sky, this could work one day.
Yeah.
It's stuff that's already working. So I don't think it's overly risky in terms of what they're spending.
All right, then let's look at your last pick, Microsoft. That cloud business doing really well, and I guess the revenues, the profits from that also funding their AI spend. They're also heavily invested in ChatGPT's owner, OpenAI. Take us through your analysis of that counter.
Yeah, I mean, interestingly, everyone thinks these tech stocks are just cruising in terms of share price.
Yeah.
Microsoft sitting at 400 is actually down over the last year. They were trading at about $420 a share this time last year. So they've been going backwards. And that's why I wanted to talk about it, because I actually think that's a good buying opportunity. You know, they have found themselves in the middle of the ChatGPT conundrum when it comes to DeepSeek. It seems like DeepSeek was targeting ChatGPT specifically, and they've put a lot of money into that. But they've also used a lot of the ChatGPT technology to put into their own branded products like Copilot. And then there was talks, well, not talks, but it came out that they were canceling a few leases on data centers, and they were concerned that maybe you know, the demand wasn't quite meeting all the money they've put into capacity. But I don't think that's the case. I think this is a good buying opportunity. The expectations are huge for the data center growth. You know, their Azure cloud services is already massive, and when it grew 19 or 20% per annum, expectations were for 25. That's sort of seemed to negatively impact the share price. But essentially, there's so much going on with this business.
Yeah.
It's an amazing annuity business in terms of, the Microsoft suite of services that service every industry out there. And it just ticks every box. Massive moat, huge cash balance, big upside from the AI play, and a well-diversified business. So if you're looking for something that's maybe a little less exciting, a bit boring, but is offering good buying opportunity because of a share price pullback, then I think Microsoft ticks all those boxes.
Byron, thanks so much for joining us and just sharing analysis on Microsoft, Nvidia, and Meta. That was Vestact's Byron Lotter.